Back with India Market Open right here on NDTV Profit, and just ahead of the start of the conference season, if you can call it, or conference season 2.0, because nowadays there are a clutch of investor conferences happening, but one which is very large, and we are pleased to have in the Emkay think tank Nirav Sheth, CEO of Institutional Equities, and Seshadri Sen, Head of Research and Strategist Institutional Equities at Emkay Global, ahead of the Emkay Confluence, which is their trademark flagship investor conference. Gentlemen, both of you, thanks so much for joining in. Interesting times to have a conference, considering the fact that all that's happening. So tell us a bit about what are the kind of companies coming in fine, but what is the predominant question from your global and local clients about what they expect out of this conference?
Well, it's you know, the way you want to look at India is that it's always been a structural story, and then you got this kind of obstacles that keep on coming in, and that sort of distorts the near-term view on the market. And it's a serious stuff in terms of what is happening on the trade war and all that. Yeah, and therefore people are looking at questions, and it's not that, and the answers are not easy because the companies are not aware, right? So there is this big gentleman, and we have no idea in terms of what is his ultimate objective, right? So how do you negotiate with a guy where you don't know what the end objectives are? So it's a tough time, but I assume that, so we are blessed with a large domestic market. It takes time to try and re-pivot to something else, finding new geographies and all that. But I suspect that this will last for a while. I'm just getting that, you know, it's a gut feel.
This tariff problem will last for a while?
Yeah. It doesn't seem to be a Russian oil sort of a scenario. It's something more than that. That I'm hoping that we sort it out before 27 August. But I suspect that we should brace ourselves for a longish battle. I'm just getting that gut feel more than anything else.
Yeah. No, I mean, I think you're not off, Nirav, considering that he's not taking the same action. Trump, the big man, like you said, has not taken the same action against China, which is even a larger consumer of Russian crude. Maybe this has to do with that 35-minute call which was reported over the weekend or whatever it may be. Having said that, then what are you saying to clients? What are the kind of companies that they should look at? Because you can't really, in this world of globalization, look at companies that have nothing to do with global trade. You'll be very, fenced in then in your choices.
No, I think you'll be surprised. So my sense is that you have a lot of companies which are largely domestic oriented. Let me, for example, tell you that if you look at the next 5 and 10 years and where you believe large addressable opportunities that come up, right? Platform companies. So, and this has absolutely nothing to do with what happens in other parts of the world, right? So, or you talk about largely infrastructure and, B2B businesses. B2B businesses in some form obviously will get impacted. So, that there is one segment of the market gets impacted, but consumption story, a lot of them is India focused. But eventually it impacts, right? So there are large sectors that will get impacted. We don't know about IT services, right? Because again, we're just talking about trade, but who the hell tells you that it can't come to services, right? We have no idea. There's no template for that. So you try and readjust the portfolio. You always have to deal with the cards that you are given, right? There's nothing you can do about it. So you try and figure out what can generate the best alpha. But there is an impact nevertheless, for sure.
And Seshadri, unfortunately, it's not that the earnings season gone by and the commentary that has come out really gives a dramatically, diametrically opposite benefit to investors, right? So the question therefore is that if you have this whole tariff tantrum going on right now and India now being at the center of it, valuations at 23, 24, 25 times depending on your estimates, and earnings commentary as well, not as buoyant as you would have liked. Is there a case for this correction that we've seen in the last 6 weeks to continue further?
Yeah, it's a very important point, and we said it, we've been saying it, that markets were anyway vulnerable. So tariffs is probably the proverbial straw, but even without the tariffs, the markets were looking a little vulnerable as we entered the earnings season. First of all, you're right, concurrent economic indicators are not particularly inspiring at this point in time. Demand levels, if you look, we looked at a vast swathe of economic indicators, and none of them seem to see a consumption recovery. Monetary policy transmission is yet to happen. And so we entered this earnings season on a slightly weak macro note. And then it was expected that this earnings season would be a little poor. The previews, etc., that most houses, including ours, we were publishing, it appeared that this was a weak earnings season, and that's how it's played out. The good news, however, is that forward earnings, so we've been seeing this is the third or fourth successive weak earnings quarter. But in, say, October last year and January this year, you saw forward earnings getting cut very dramatically. Through this earnings season, it's broadly held up. I think the Nifty earnings come off by maybe 1% or so. And therefore, I think I wouldn't worry too much about the fact that the earnings season is bad. It is too early to expect the monetary policy transmission, and I'm very sure that once monetary policy transmission happened, and that's not just interest rates, but it's also that there is more liquidity, some of RBI's restrictions on lending have been removed, and once credit flow starts in earnest, which I expect towards the end of this year, early next calendar year, you will see an acceleration in demand. So, yes, the earnings season has been bad, the commentary is weak, but now it's been the third or fourth successive weak season, so managements are understandably conservative. They will not guide you for a recovery until they see it on the ground. Analysts are also conservative, therefore their estimates are being cut, and there is no further room for cuts as we are seeing. So, meaning, yes, if you look at the current state of play, it may look weak. If you look at a 1 year forward, I think there is enough cause for optimism. And yes, while the tariff is bad news, undoubtedly, as Nirav was saying, there are plenty of sectors which are unaffected by tariffs.
So where are those silver linings coming in? And if I can ask this question of both of you, sectors, spaces, companies, or what is looking exciting? What are the most buzzing companies that everyone wants to talk to at your conference this time?
So, our starting hypothesis is that we've seen rate cuts, and we still believe that there are rate cuts in the fray, despite the fact that RBI government has done what he has done, which means that it's a great benefit to all the NBFCs. So within banks and NBFCs, we clearly believe that you've got a 2-3 year run for NBFCs. And the reason for that is that if you actually look at private sector banks, as we see now today, their 2-year earnings CAGR is just about 9-10%, which is a bit of a problem, right? And maybe because your provisions are coming back to average or whatever it is. If you look at most of the well-run NBFCs, when I talk about well-run, I'm talking about corporate-led, AAA rated NBFCs. They have grown at about 25% in the last 3 years. The guidance is to grow at 25% over the next 3 years, and therefore the divergence between the growth rate for NBFCs and banks is huge, which means that there's a big flow of money that gets into that, right? This is a heavily owned sector, which is not probably going to do as well till the time credit growth picks up, and therefore that's an pocket of growth that comes out. I already referred to platform companies. You should be bullish on something like L&T, the domestic infrastructure. Some of the sectors over there are very, very cheap. So, barring consumption, which is again a valuation-led issue, I think that at least some of these sectors, I remain fairly constructive. Sam may want to add.
Yeah, in addition to that, consumer discretionary, which has had 4 to 6 bad quarters, and we see a recovery coming. Some of those valuations have now moderated.
So you mean the AC compliance appliances businesses, those?
No, consumer discretionary is mainly autos if you look at weightage. Okay, but there is also that consumer electricals.
You think autos will come back?
Yes, I would selectively start looking at autos at this stage on a forward-looking basis. In a short-term cyclical cycle, I would prefer to look at two-wheelers, but from a longer-term perspective, four-wheelers as well. And some of those stocks, if you've seen, despite the numbers being weak, have already started doing quite well in the last 5 or 6 months. And industrials, as he was alluding to, that is the other sector there where we are overweight. Some of the other themes that we are looking at are the airlines. We think that airlines is set. The entire airline ecosystem, the long-term structural growth is very strong. You're seeing 2 new airports come in the next 6-8 months. You're going to see an increased capacity. So there's a lot to talk about there as well.
Okay. Final question, Nirav. Your keynote addresses from keynote speakers as a platform company, as a large green energy business or a conglomerate talking about presumably the green energy business, etc., etc. What is going to be your central message to investors? Buy India currently or at dips, or wait for the time to pass?
No. See, I mean, we're not talking about someone trying to create a personal portfolio who can hopefully, wait for some time and then put in a few crores here and there. If you're talking about, institutional investors, deploy billions of dollars.
Even they can time the market.
I don't think that you've got enough space. So I don't think, despite what tariffs we are talking about, I don't think they have to be looking at a worst case scenario Nifty below 24,000, which means that you are almost there, right? Which means that some of the stocks may not fall. Actually, they may even rally, right? So I am not a great believer. If you believe that, so 3-year returns, I think in Nifty by and large has never been negative. There is a 0.007% chance. On a 5-year basis, it never loses money by and large, right? So, and like I said, so what you're seeing right now, right, is largely, I believe that we have run an unusually tight monetary policy, right? So it is our own doing, right, which we are now reversing the course. And therefore, the growth is obviously certainly going to come back. And you don't have too many $4 trillion economies growing at 6-7%. In India, if you don't do anything, you'll grow at 5%. If you do reasonably well, which is what the current government is doing, you will grow at about 6.57. We are still not, we don't have an ideology to try and push the growth rate to 8%, which is what I want, which means that you should be far more fiscally supportive. You can't look at real interest rates if my credit to GDP ratio is flat over the last 10 years. Credit has to come back in the system, stuff like that. Maybe at some point in time we'll go over there. But this is a growth that will die for. I mean, what else would you do? Where else will you invest? That's a question they have to ask, right? Because returns are always relative in life. Where would you go?
Okay, and enough domestic investors at least asking that question, whether the foreigners are or not. I think that's also one big theme that you'll be seeing. We're right out of time, but thank you so much for coming in and on that conversation. Of course, best of luck for that conference.
Thank you very much.
We'll wrap up on India Market Open at this point, but stay tuned. Ask Profit up next.